Tobias, thanks very much for joining us. There's a new edition of the GARBE Pyramid research, and I know that's research that you've been doing on a regular basis every 6 months. So it'd be interesting to get some of the key takeaways.
Yeah, hi, Richard. You're right. We are updating on a half-year basis, and new research, as you know, is more important than ever because we're in this really special situation because the market circumstances changed quite a lot. If you look at the investment volumes, for example, we saw a decrease for the second year, and at the moment, for example, a decrease from the investment perspective from the total volume for logistics asset, it dropped a little bit over 50% compared to other asset classes where it was even more intense. For example, the office for asset class where it dropped by 60%. But compared to the long term, it's still quite strong. Even if the output, the volume in total is much lower, the ratio of logistics as an asset class over the long term increased to roughly about 1/5, or in some countries even to a quarter of the total investment. So we see a shift of the interest towards logistics and real estate in general, but because of the heavy disturbance when it comes to inflation rate based interest rates, it was totally different than the year before. We were coming from a really record-breaking level to a reduced volume. We call it, when it comes to the investment market, quite remarkable. When it comes to the take-up, then it's quite a normalisation.
Yeah, and I guess looking at some of the markets, what are you seeing in terms of the Eurozone overall, and how does that drill down into the different countries?
Well, yes, there is still a different pattern. It's not all the same, even if we see markets moving together, they're not as different as they were like 10 years ago or so. But the pace of the countries is different. In many situations where we have a crisis, UK is leading the pace, where we already see a bottoming out, followed soon after by countries like the Netherlands. For example, if you look at the decompression of the net initial yields, we saw only in the last half year a decrease of a few bips anymore. In Germany, for example, it was totally different. We saw a decompression for 30 to 40 bips. So here we see still a small way to go, maybe one, maybe 2 quarters. Everyone is waiting to see how the interest rates is developing in 2024. And like most market participants, we expect to see the first reduction of the rates. The ECB will start, I guess, after the first half year. And then the other markets, which are still in a decompression phase, will soon follow thereafter with a slight improvement of the overall situation, a slight increase in investment volumes. But other markets like the UK, like Netherlands, are already slightly leading the pace, and there it will begin a little bit sooner with the increase of the investment volume.
What are you seeing there in terms of take-up and rents, for example?
Yeah, we saw still a huge increase in rent development. This is totally in contrast to the yield development. Up until the last few months, it was still a huge take-up, a huge demand, even if some of the main drivers of the past, remember the times of the COVID pandemic situation where we had a huge boost for e-commerce demand. This totally changed together with the inflation rate and the interest rate change because the consumer climate was so bad. So this driver was really low, but still we saw a huge level of demand. This came together with many markets really, or historical low vacancy rates, combined with a decrease of developments because the financial situation was getting worse for spec developments, for developments in general. But the basic demand was still high. So this led to a really huge increase of rent levels. We saw in our pyramid time series of the last 5 years an increase for over 2 or roughly 2.5 euros per square meter for the top markets in our pyramid map. And for the second tier markets, even 1.5 euro per square meter. So quite a huge increase. In some markets, even more. And they are beginning to diverge. Looking, for example, to the German market, a few years ago, the market for the top, or the rent levels for the top markets were quite near together as a big group. And now Munich, for example, has developed much farther away with a gap of a few euros for the top rental levels. And the market itself changed places because the demand in some instances of the markets were improving, where it stayed more or less the same in other markets. Well, the general pattern was increase, but the places between the market changed quite a lot. Now we see a change in demand because the geopolitical tensions, the uncertainties, the recession phase of many economics are leading to a more cautious approach from the tenant side, together with already very high levels. So there's for the tenant not always a possibility to pay for higher rents. This is especially true for second-tier markets, whereas at the main markets, the top markets, we see still an increase. But when it comes to percentage, we had double-digit figures for the last year, for example, in many markets. This is now dropping. Well, it's still above the inflation rate, so this is a quite good, but the increase will be much lower, I guess, roughly 4 to 5% in the major markets, and even in some of the second-tier markets, more or less the stabilization of the rent levels on a high rate.
Part of the interesting thing around this, Tobias, is that look forward in terms of the sector for 2024. How do you see some of these indicators for the sector going forward?
2024 will be a year where it's more or less step by step, see how the overall geopolitical situation will develop. A huge part of the world is going to elect, to vote this year. So this could lead to a huge impact on the demand side, on supply chains. But generally, everyone is quite sure that the interest rates will drop in the US, in the Eurozone, in the UK. When it will happen, it depends on how fast the inflation will decrease. So we guess the first half year of 2024 will be more a wait and see attitude still. And then the second part of 2024 will be the start of a new cycle, especially for the investment cycle, then picking up pace in 2024. When it comes to the tenant side, to the demand side, we expect that e-commerce will pick up again in many countries in the Eurozone because the e-commerce penetration in the most markets are not as high as, for example, in the UK. There are new types of e-commerce coming up. Look, for example, to social commerce. Players like TikTok, Temu, Shein will establish a logistics network in Europe as well, because they don't have it at the moment. This is also true for companies focusing more on the European market because of the disturbances in the supply chain, the Red Sea crisis, for example. So this will all lead to a resurfacing of a higher demand level. But again, at the moment, we have a stable demand level. It's below the record-breaking heights of last year or even the year before, but it's totally in line with the 10-year average, and it's really quite strong. We don't see any high vacancy rates. In some markets, a little bit higher, where, for example, many spec developments are being finished in the moment. But there won't be much building activity for the near future because it stopped really within the last year. It dropped really, and this will lead to the situation that a lower output for new space is combined with an increase in the demand. So this will lead again to lower vacancy, higher rental development, and this will be especially true for 2025 at the latest.
Yeah, really interesting to hear those views, Tobias, and that positive take on the market. And it will be interesting for sure to see how some of those macro trends play out, and interesting to hear that about the social media side as well. Thanks very much for joining us, Tobias.
Yeah, I'm glad to be here to speak with you. Stay tuned for the next edition we will publish in 6 months.